Do you have income protection insurance, or are you thinking about buying it? If so, there are some important changes coming on April 1 which you should know about. In this video, we'll explain how income protection works, the upcoming changes, and how to find a policy that fits so you can make an informed decision well before the deadline. So first things first, what is it? Basically, income protection insurance is a financial safety net if you ever become too sick or injured to work. It's designed to kick in when your regular income is suddenly cut off, paying you a percentage of what you typically earn so you don't fall behind on your bills. Right now, there are two types of income protection: agreed value and indemnity value. Agreed value is generally the more expensive of the two because when you buy an agreed value policy, you decide there and then how much you'll get from your insurance company if you have to make a claim. With indemnity value, you don't have that choice. Instead, if you have to make a claim, the insurance company will look at how much you've earned over the past 12 months and give you a percentage of that amount. So what's changing on April 1st? The insurance industry is losing money on agreed value policies, so from April 1st, they'll no longer be selling them. This means you'll only be able to get an indemnity value policy after that date. However, if you've already got an agreed value policy or you buy one before the April deadline, you will be allowed to keep it. So what does this mean for you? Well, agreed value policies are great for people who don't always have a consistent income. So that's self-employed people, small business owners, mums and dads taking parental leave, anyone with a commission-based wage, and anyone who's planning on taking a pay cut to retrain or maybe move into a different line of work. Take Tom, for example. Tom runs his own plumbing business and regularly earns $100,000 every year. He buys an income protection policy after April 1, which promises to pay out 75% of his income if he ever has to claim. 2 years later, Tom is diagnosed with cancer and can't work for 6 months. He turns to his insurer for help. Unfortunately, business has been unusually slow for Tom in the past year, and he's only earned $80,000. Tom's insurance company bases its payout on this figure rather than the $100,000 he was earning when he bought the policy. If Tom had bought his income protection before April 1st, he would have had the option to buy an agreed value policy. If he'd done this, Tom's payments would still be worth 75% of his $100,000 income, even though his earnings over the past 12 months have been less than they usually are. Over a year, that's a potential payout difference of $60,000 versus $75,000. People like Tom aren't the only ones who may be impacted. Sarah is a new mum and she's just returned from parental leave 3 months ago. She also has indemnity value income protection rather than agreed value. If Sarah's suddenly unable to work, say she gets into a car accident, her insurance company will only give her a percentage of her earnings over the last 12 months. Because she was on maternity leave, it'll be significantly less than her usual income. While the changes could be bad for people like Tom and Sarah, they won't impact everyone. However, there are more changes coming next year which could affect your coverage again. It's just another reason to consider buying income protection insurance now. You've got nothing to lose by doing so, but you could be worse off if you wait. Remember that the first major change is around the corner. After April 1st this year, you won't be able to get an agreed value income protection policy anymore. And remember that these agreed value policies can only be bought by speaking to a life insurance advisor. So if you're one of those people who does have a fluctuating wage, you should probably look into comparing providers sooner rather than later. Head to Finder to compare policies and learn more about these changes. The link's below. So drop us a comment, or if you have any questions, let us know and we'll be happy to answer them.